Hello and a warm welcome to Econoday Unplugged on Wednesday, the 20th of October, 2021. Terry Sheehan is on the US East Coast, Max Sato's in Victoria, British Columbia, Brian Jackson's in Sydney, and I'm Jeremy Hawkins in London. While by and large, central bankers around the world now seem to accept that the rise in inflation seen so far this year will last longer than originally expected. Most still seem to expect to return to more normal rates in 2022. But the recent sharp jump in energy costs has clearly pulled forward investors' view of prospective monetary tightening. Nonetheless, in some countries, there are increasing signs that higher prices are also hitting economic activity. And for the policymakers, that's going to widen existing splits between the doves and the hawks, complicating the delivery of clear and concise forward guidance and so potentially adding to market volatility. Consequently, with a number of central banks due to make policy announcements over the next few weeks, it could be a bumpy ride. Now, it's not monetary tightening everywhere, and a clear case in point is China, where the economy would seem to be not only slowing, but doing so rather more quickly than expected. So let's kick off with Brian. Okay, then, Mr. Jackson, much weaker than expected third quarter GDP. I guess the key question is, was it sort of mainly due to short-term issues, assuming supply chains and so forth do get back to normal soon? Or was it more a function of shifts in regulatory policy and the like that could have longer-term implications for the economy?
I think it's both, and I think it's also, it could be a reflection of this long-term objective that the Chinese officials have to try and change the growth mix for China over the long term, transitioning to what they see as a more sustainable long-term growth rate built on a different mix of factors rather than what they've tended to rely on in the past. Now,
Right, let me be rude and interrupt you immediately.
Yeah.
What do you think might be the kind of the longer term growth rate that they're looking at now?
I mean, they don't put a number on it, but obviously, we're sort of used to 8, 9, sort of even 10% year-on-year growth a lot of the time, and we get quite shocked if it's sort of around 4, 5, 6%.
Right.
But obviously, those bigger growth rates that we used to see were based on a particular economic model, which I think they're trying to move away from to something that's more sustainable, more focused on consumption, less on just sort of building roads and apartment blocks whenever the numbers start to slip. Now, whether they hold their nerve, that's the other issue. Whether they're able to sort of deal with any short-term impact of seeing those growth numbers slip, that's the big question. But that's definitely their sort of aspiration to try and move to a different mix for economic growth.
Right. Okay. Obviously, so much of the talk has been around Evergrande in recent weeks, particularly in that part of the world. I saw that property prices dropped to the first time in 6 years in China in September, and what housing activity I think accounts for, well, not far off 30% of GDP. So, I mean, what's happening sort of the housing market or residential property market now, and how important is that going to be potentially to the likes of what the central bank does?
Yeah, well, I mean that definitely flows into what I was just saying about how changing the mix of economic growth. They've relied for so long on building these huge apartment towers in these cities that tend to be unused. Just whenever growth is slipping, you just knock up another apartment tower somewhere to bump up the numbers in your region. And so that's a long-standing problem, and I think people have been predicting problems in the property market for a long time in China. At the moment, I think they're obviously concerned about Evergrande Group just because it's such a large property developer, and they're trying to shift some of the balance sheet to other state-run property developers to try and manage it. But yeah, it's definitely going to have an impact, and I think it's impacting confidence and sentiment in the property market. If you're thinking of buying a unit or apartment somewhere, you might be a little bit concerned about what is going to happen over the next 12 months. And so we saw yesterday with those Chinese house price numbers, just a very, very small month-on-month dip, but the first one in 6 years, as you said, and in year-over-year terms, has also been slowing. So, obviously Beijing has levers that it can pull if things start to slow down too far. But at the moment, I think they're reasonably optimistic that they can manage this latest issue. But we'll just have to wait and see.
All right, then before we leave China, I'm going to ask you policy and all that. There seems to be a lot of speculation that we'll see another cut in the required reserve ratio, and perhaps sooner rather than later. What's your bet on that? And do you think there's any chance of an actual cut in interest rates?
I think it is more likely they'll go with reserve requirements if they want to tweak things. And that's sort of definitely been the pattern over the last year or so. They haven't moved on that loan prime rate for 18 months. And so I think that's what they would do. But again, it's interesting that they're just pulling all different other types of levers as well to try and change the mix of economic growth and meet a variety of policy objectives. One of the big reasons why we've had this slowdown in Chinese growth in the last 6 months has been what they're doing on energy consumption.
Right.
So, some of it is motivated by their concerns to do what they need to do with emissions and to be seen to be working in that front. Another issue is that it's a result of their sort of trade spat with Australia over the last 12 months or so. They've told state-owned firms not to buy Australian coal, and now there's coal shortages and energy price increases, and that's curbing many parts of the industrial sector. So there's all these sort of different policy tools and objectives that are sort of impacting what's happening with the GDP headline number.
Interesting stuff. Okay, we mentioned Australia in there, so let's shift across to, well, your immediate part of the world. Last Wednesday, we saw another hefty fall in employment in September, but full-time jobs were up a lot. So, I mean, is that reason for expecting a decent bounce back, perhaps in fourth quarter GDP?
I think we should expect that. There should be a pretty solid bounce, but we're going to definitely get a pretty weak number for the September quarter. But as we know, it's all being driven by the lockdowns that we've had in Australia's two most populous states, New South Wales and Victoria. They were pretty much locked down the whole September quarter. Here in New South Wales, where I am, where we've started to come out of lockdown in the last 2 or 3 weeks, and in Victoria, that's hopefully going to start happening soon as well. So you would expect there to be a big bounce back in most key activity indicators. A lot of pent-up demand. We're obviously coming into the summer here and the holiday season, and people are hoping to start traveling around and do a lot of stuff that they haven't been able to do for the last few months. So I would expect those numbers to turn around pretty sharply, and that's definitely what the Reserve Bank of Australia has been expecting as well.
And in terms of inflation, in the intro, I talked about a lot of central banks seem to be becoming at least a little bit more concerned that inflation will last longer and higher than expected. What's the RBA stance now? Is it still very much the case we're quite happy with the way the economy is progressing and interest rates are still a long way down the road?
Yeah, it is. They've been very consistent, and we're again saying the same message this month when they left policy rates on hold. They're definitely acknowledging some of those short-term impacts pushing up the CPI, but they're still sticking with the view that over the long term there's just going to be a gradual increase in inflation over say a 2 or 3 year period once we sort of get through any short-term volatility. So they're still looking pretty comfortable about the inflation outlook, and in fact what they're saying is that we need stronger labour market conditions to start pushing up wage growth to get inflation sustainably into our target. So they're actually more concerned about the labour market still and getting some wage growth into the picture. So there's still no shift in their view that policy rates are on hold for the foreseeable future. They're still saying to 2024, more than 2 years away. It might that might change over time. We've still got a long way to go until 2024, but there's definitely no indication that they're thinking of moving soon.
All right, and I guess compare and contrast with New Zealand. You had the third quarter inflation numbers, the highest we've had in 10 years or so. I know that the RBNZ hiked in October. Do you think they'll be inclined to raise rates again at the next meeting in November? And indeed, ultimately, we're clearly in a tightening cycle now for the Reserve Bank of New Zealand. How far do you think the official cash rate will actually go?
Yeah, I mean, you would expect them to have the goal of trying to just get things back to normal. They cut rates, obviously, like everyone did, aggressively in the initial aftermath of the pandemic, and I think most policymakers are not comfortable having rates at these sort of historically low levels, and they'd want to just get back to where they were, pre-pandemic eventually. But they're mindful still, I think, of going too quickly, but their activity numbers have been pretty strong, so that gives them a little bit more leeway, and they haven't had as big a lockdown or as damaging a lockdown as we have here in Australia. So I think they're just a little bit still more focused on getting policy back to sort of normal levels more quickly.
Okay, great stuff. That was my questions. Anything else you want to put in from your side?
No, I mean, China obviously is quite interesting, and also feeds through to the big story on everyone's minds, really. This whole supply chain disruption story, is something that has a big Chinese component to it. If you look at the market PMI surveys, they were talking about supply chain disruptions 4 or 5 months ago. So they were a bit of an early warning signal that this is something that was impacting many parts of the Chinese manufacturing sector. You had COVID outbreaks in some big manufacturing areas in some of the big port towns in China. So if we can sort of fix some of those problems in China, then that might alleviate this bigger issue of supply chain disruptions. That's obviously the focus right around the world at the moment.
Okay, great, excellent. Thanks, Bram. Max, Japan. Start of the month, Japan dropped, most of its state of emergency for the first time for the coronavirus stuff for the first time in about 6 months or so. So are we now looking for some kind of pickup in fourth quarter GDP?
Are we talking about the October, December?
Yeah, well, that's right, yeah.
Right. Yes. I think by then we'll have enough momentum to see growth picking up a bit, but I'm afraid that July, September still the effect of the restrictions on economic activity in place. So that would be weaker. Economists have been revising down their forecasts. What probably policymakers and some consumers are concerned about, and smaller businesses as well, is there's going to be a debate in Japan about good inflation versus bad inflation. Good inflation.
That's got to be a good debate.
Sorry?
That's got to be a good debate. Sorry, do continue.
Right, yeah. Okay. This may not happen so soon, but when the negative output gap is closed, and there's going to be an steady increase in the working population, then we'll see a gradual rise in growth potential, and then see gradual pickup in inflation. But what we see now is producer prices were up 6.3% recently, which is a 13-year high. Coincidentally, the US also had a 13-year high. But then if you take a look at the consumer price index, it's basically flat or negative, but if you see total CPI. So this means companies, smaller companies are the majority in Japan. They cannot pass along higher costs. And if you take a look at big companies like Toyota, they can ask their contractors and subcontractors to cut prices, but to cut costs. But we may see, if the yen continues to depreciate against the US dollar beyond the current level of around 14 towards 115, 120, then there's going to be verbal intervention from Ministry of Finance and the Bank of Japan. So if I could take you back to 2015, the background is Japan raised the sales tax in April 2014, and the negative impact lingered on for over a year.
Mm-hmm.
And the at the time, the dollar went up to 125, above the actually a 13-year high of 125.86. Then Governor Kuroda, in his first term back then, said rate hike by the U.S. Fed may not necessarily cause the dollar to appreciate and the yen to depreciate, and the dollar came back down to 123. And generally, Japanese policymakers see dollar yen range of 105 to 115 fine, comfortable. Maybe in a wider range of 100 to 120. But if you take a look at the past public comments, if the yen continues to depreciate beyond 120, 125, then politicians going to start highlighting the negative impact of the fall in purchasing power. And at the same time, a stronger yen doesn't really kill exports, because a lot of Japanese companies have already located their factories all over the world. So we might see a mirror image of what they said in back in 2015.
Interesting. Okay, yeah, it's going to be fascinating to see how these sort of dislocations we have in monetary policies dotted around the world at the moment play out, particularly in terms of exchange rates. Okay, great. Thank you very much for that. And so to Terry. And US, where I guess it's fair to say that recent data have been, at best mixed. Next week, we're going to get the first look at the third quarter US GDP numbers. And I've got to say, I see that as of Tuesday, the Atlanta Fed's nowcast call was down at just 0.5%. Does that look reasonable to you?
That seems low to me. The Atlanta Fed's nowcast tends not to correlate all that well with the actual advance estimate when it's first released. The St. Louis Fed actually does a little better with that. Mm-hmm. They're substantially higher than Atlanta right now.
And by substantially higher, you mean?
Oh, let me see where my notes say. They're like over 5%.
So substantially higher, which kind of makes you wonder, how on the earth do you get two such different numbers?
Well, it does, but they measure different things. And it also depends on where we are in the data release cycle. Right. Now, like last week, we got a really strong retail sales report compared to expectations. Everyone was expecting the motor vehicle sales component to be significantly lower because we've had drops in unit sales of cars. But what's happening is car prices have gone up and people are having to buy whatever is on the dealer's lots. Right. And frequently this is a more expensive vehicle. So we actually had an increase in the dollar value of motor vehicle sales. So anyway, I think the Atlanta Fed's probably down on the industrial production report, which was quite weak relative to expectations. But if you look behind the down 1.3% in the headline, manufacturing was down because of motor vehicle sales and the shortages, or motor vehicle production and the shortages of semiconductors. That was down 0.7%. But there were also substantial drops in mining, which was a result of a hurricane in the Gulf of Mexico, which shut down a lot of activity, which will come back in the next month's data. And then utilities output was down because the weather was much cooler in September than August. And there was some slowdown in manufacturing, which also meant that demand for utilities was down. So some of this is just some of this I think is a one-off. So I think that Atlanta is probably too low on this by far. The other thing is that people keep harping back to the employment report and the relatively weak headline there, but the quarter average for the third quarter was 550,000 a month, and this is good gains in the labor market overall. So I think the month-to-month fluctuations are maybe distorting some of the expectations for how the economy is performing right now. I think if you look at somewhere in the midpoint of the two estimates, we're looking at somewhere like 3.5% to 4% growth for the third quarter.
Okay, can I ask you about the consumer sector? You mentioned the retail sales numbers. Now, of course, in contrast to Europe, yours, as you said, they're in nominal terms. But I mean, if I got my numbers right, real retail sales are only up about, what, 0.3% on the month. And you began the quarter with a really big drop. So on my numbers, it looks as if the third quarter volume sales are going to be down quite significantly from the second quarter. We had another low reading on the University of Michigan survey. Is there some doubt that perhaps the consumer sector is not going to provide the support to growth that the Fed might be hoping for, or is that too negative an assumption?
I think that's too negative an assumption. From what I can see from anecdotal evidence, consumers are out there spending. Whatever their confidence is, they're buying houses. They need goods for them. Their kids are going back to school, so they need school supplies, clothing, things like that. So I think while the hit on consumer confidence is there, it doesn't necessarily translate into actual buying patterns. And some of the things that may be slowing retail spending right now are things like low inventories of goods.
Right. Okay. Well, I suppose pulling some of that together, a short while ago you had the Fed Beige Book, which obviously the Fed has a lot of interest in. Did that have anything interesting to say? Anything which might change your view of the way the economy is performing, or did it kind of fit in with your sort of central case scenario?
I think it fits in with the central case scenario of growth has moderated from the second quarter in the third quarter. Of the 12 district banks that reported, 5 had very slight downgrades, and we're talking things like changing the language from moderate growth to modest growth. But
right.
all 12 district banks reported growth. Some of them were quite strong. And so I think overall, the performance of the economy has been good. Now, it did cite that there was increased uncertainty related to things like the supply chain disruptions, the ongoing COVID pandemic, and these are real problems. The other thing it talked a little bit about was that inflation seems to be significantly more elevated than it was, and there are not insubstantial price increases going on for manufacturers, but they also seem to be able to pass on a lot of these increases, which is interesting because in past episodes where we had somewhat higher inflation, there were big efforts to save costs however they could and not pass it on to their customers. But it seems to be happening here, at least to an extent. And the other interesting thing there was apparently at least some districts are not thinking that this is a substantial or this is a sustained inflation episode. Now, most people seem to think it's going to last a bit longer than initially expected, but the perception is not universal that this is getting entrenched.
Yeah, it's great, isn't it? Pays your money, takes your choice on this at the moment.
Yeah.
Okay, let me ask you, anything else you want to mention? Mr. Biden signed off on the temporary debt limit extension.
Yes.
Has there been any real progress, or is it the case that once we get into December, we're just going to face the same kind of negotiations and stonewalling again?
Well, the advantage of having it in December is everybody wants to go home for the holidays. So
I've got to say that is a fairly sad comment, but of course perfectly plausible.
Well, the fact of the matter is, when they're up against a deadline for the end of the session, is when they tend to get a little more realistic in their negotiations. I think it will be. I don't think it will be that much easier to get resolved, but I think having a little cooling off period between now and then, and a chance to talk to their constituents, that it's more likely we will get a better agreement when December rolls around.
All right, let us hope so. Anything else from your side you'd like to put in the pot, Terry?
Just mentioned that we've had a lot of Fed policymakers in the news lately, and it looks like the consensus on the FOMC is 100% toward tapering asset purchases. So the expectation is now pretty firmly in place that we're going to see that at the November FOMC meeting.
And just your best guess in terms of what sort of tapering we'll get?
Well, I mean, they will start to taper both treasuries and the MBS that they've been buying. It depends on how long they anticipate it going. It's right now, it's about 120 billion a month. They were talking about mid 2022, so we're talking maybe an 8-month period. So if you're going to do a complete taper, we're talking probably 15 billion per month in cuts.
Right.
I don't know if they'll actually do it that rapidly, though. They may consider that a little too steep and put it off another month or two.
Right. Interesting stuff, as always. Thanks for that, Terry. North America, we stay with. Max, if we can go back to you, and Canada. Last week, the Bank of Canada governor, Mr. McCallum, said, so far, to quote, so far, we're not really seeing evidence of sustained inflation. So today we had another very strong September CPI out of Canada. Well, we got inflation now running, headline inflation at its highest rate since February 2003. So do you think that we will see further tapering from the Bank of Canada later on this month? And indeed, is it possible that they might actually pull forward what they currently say will be the first interest rate hike in the second half of next year?
That's going to be very delicate debate, I think. I'm sure they're going to talk about tapering further from that was currently at 2 billion. They reduced it from 3 billion in July. But growth and recovery pace is really uneven. The story is the same almost everywhere, in Canada too. Service sector is picking up slightly in the current quarter, the last quarter. And but then if you take a look at the manufacturers, they've been hit hard by the global supply chain breakdown and also labor shortages. As you can remember, the last time the bank announced their policy, they said the economy still needs extraordinary monetary policy support. They're talking about probably not going to raise rates until later next year. But I'm not sure if they're going to bring forward the timing of the possible first rate hike from the second half of next year. And they may, though, adjust lower the growth forecast from 6% for this year. So I think labor shortages are serious. I can see restaurants and some other places reopening gradually, but they cannot find enough people who would like to do that kind of job, because I was talking to the owner of a painting company who sends students to paint people's houses. He said the students would rather take the government cash handout than go back to do some part-time work, and that can be the same for other people in the workforce. So that's really hurting the face-to-face services industry.
Interesting. It seems to be happening in quite a few countries at the moment, doesn't it? Could I ask you about the currency? We're talking about Canadian dollar 15-week highs against the US at the moment. Has that got any implications for the speed at which they might taper or indeed might ultimately hike interest rates? Because we know that Canadian dollar tends to be quite a sensitive thing as far as the Bank of Canada is concerned.
The Canadian dollar throughout this year has been fairly strong. There's a combination of different factors, but I'm not sure if the bank's going to link its policy stand solely or directly to the exchange rate, because it's hard to fight any tide in the market with a single shot.
Too right it is. Okay, excellent. Thanks for that. Anything else you want to put in from your side, Max?
I don't know if other people on the panel share the sentiment, but here there's kind of a dichotomy happening. Some shops are really cramming people in, like there's no distance between the tables or people, but then at the same time, some are really strict. Unless you bring in your digital vaccine passport, you can't even get in. So that's going to be confusing, I think, to the consumers and businesses. I wonder if anybody else have any observations in their own countries and regions.
Well, I think quickly mentioned from my side, there was a press statement by the UK government a short while ago. COVID cases in the UK, unfortunately, are spiralling rapidly at the moment, to the extent that new infection rates is, well, as high as we've seen since last March time. And indeed, we're close, I think, to almost being the highest in the world at the moment. So there's every chance we may see some additional restrictions being introduced over here. But certainly, it's still the case that with regards to the likes of mask wearing, it's kind of down to the individual to, to accept responsibility or otherwise. So there's hardly any areas in the UK now where you'll be forced to wear a mask. A lot of people will do because they've been suggested it's probably not a bad thing to do, but it's not actually law. Terry, what about stateside?
It's very much the same situation in terms of a lot of areas are once again heavily encouraging people to use masks, and a lot of stores have signs saying please wear a mask. Most doctors' offices or other medical related businesses require you to wear a mask while you're in them. What I'm seeing is that people who are vaccinated now are anxious to get the booster shots, while those who don't want to be vaccinated just don't want to be vaccinated. And it's really a very hard divide on the two issues. But as far as mandated mask wearing, there hasn't been a lot of movement in that direction.
Okay, Brian, what about your part of the world?
Well, here there are still requirements to wear masks indoors in many places, though they are starting to restrict that in offices. Working in offices, you'll no longer need masks, but they're still requiring it in sort of shopping centres and in schools as well for the time being. That could change, as we sort of get further vaccinated. And the other thing that we are seeing is having to provide proof of your vaccination status for the time being in some situations. But again, that will likely be eased in the next few weeks as that coverage of the vaccine gets up to pretty high.
Okay, so pretty well mixed. I suppose just quickly from my part of the world, while we're on this vaccine side, I mentioned we are seeing a sharp increase in the number of new COVID cases in the UK at the moment, and that appears to be attributed to a couple of factors. One, the fact that we're getting to the stage because the UK was very early on in terms of the vaccination rollout, and it was leading a big chunk of the world for a long time. It does seem now that some of the early immunity which was offered by the vaccine is actually starting to fade a bit now. So Terry was talking about having a booster shot, and that's certainly the way UK government's going down the same sort of road. But it's been relatively slow in that. And I suppose, without trying to be too negative about this, it does seem that the immunity provided by the vaccines diminishes over time. The good news is that the hospitalizations and the death rate in the UK is still well below where it was during the previous waves, but they are both rising. And certainly, as far as the UK policy is concerned, if you have COVID, then effectively you self-isolate, and the more you get of that, of course, the more it's going to be a hit to ultimately UK supply. At a time of limited supply, that's simply going to add to would-be inflationary pressures. So I think, although try not to talk too much about COVID on these podcasts, it's been nice to get away from it. Certainly, in some parts of the world, it is coming back, and it's certainly going to have, I think, potentially important implications for what's going to happen in terms of inflation, ultimately policies, and certainly way economies are going to evolve. Right, to more general sort of economics in Europe for my bit then. I suppose the main focus here currently will be, there's a couple of central bank meetings coming up, so really talk about those. The ECB will be meeting next week. No changes expected there. In contrast to those central banks who really are getting concerned about inflation, the attitude in general from the European Central Bank currently, and indeed has been for some while now, is inflation is still transitory. We'll probably see an increase in the inflation forecasts when we get their updated set in December, but that won't be until December. But as far as next week's ECB meeting is concerned, it's fairly certain that they won't really do anything, just come and announce no change in any of their main policy levers. In fact, it's quite interesting just looking at some of the weekly balance sheet data from the ECB in terms of the PEP, so the Pandemic Emergency Purchase Programme, which was supposed to have been cut since the beginning of October time. The weekly asset purchases, and it's always dangerous looking at with the weekly numbers because there's a lot of redemptions and volatility and so on, but it would appear that they've hardly cut the asset purchase at all. And that, I guess, is a reflection of the fact that they're not happy with the sharp rise we've seen in European bond yields, because it's undermining their favourable financing conditions, which they're so keen to achieve or retain. But also, I guess it also underlines the flexibility of the PEP itself, which they've always maintained that basically they're going to use the PEP as and when they see fit. So it would kind of fit in with the view that, well, look, interest rates, or I should say long-dated bond yields, are going up very rapidly at the moment. We don't like that, so we're actually prepared to go out and buy more assets than perhaps we would have done otherwise. I should also mention, just in terms of the ECB, there was news today that the Bundesbank chief, Jens Wiedmann, will be stepping down early. He'll be quitting his job as head of the Bundesbank, but also a key member of the ECB's governing council. He'll be quitting at the end of this year. So he will be around for what's widely expected to be the most important, or one of the most important meetings of the year in December, but he won't be around after that. His replacement will be appointed by the incoming new government, which, although it's not actually determined what shape that's going to take yet, it will certainly be more left of centre, probably headed by the Social Democrats. And to that extent, it could mean we actually end up with his replacement being, let's say, not as hawkish as Wiedmann has been in the past. Certainly, Wiedmann's been widely recognised as being one of the most hawkish members of the ECB. So it could mean that, in terms of anyone looking for any kind of tightening out the ECB, the change there might make it even further down the road than generally expected at the moment. Potentially more interesting, and one which is getting a lot of the talk in the financial press at the moment, is what the Bank of England's going to do. They won't be meeting until the first week of November. But on last week's podcast, we suggested that the Bank of England might be the first of the major central banks, at least for G7 central banks, to come out and tighten policy. Well, if we believe what a raft of central bank speakers have been saying over the course of the last week or so, it looks even more likely, to the extent that financial markets now are effectively discounting an increase in short-term interest rates, around about 40 basis points or so between now and the end of the year. So possibly an increase at the next Bank of England meeting on November the 4th, and another increase possibly when we get into the December meeting, the year-end one. And that really does seem to be a reflection of the fact that the huge increase we've seen in particularly UK energy prices, where the consumption of gas is disproportionately high compared to a lot of continental Europe. That's really worried the central bankers, and they really do seem to have come out with something of a fundamental U-turn on their interpretation of where inflation is going to go. They were very much a la ECB be in the camp that don't worry about it. The rise in inflation is just going to be temporary. It's going to be transient, and we'll get into next year and it'll come back down again. So don't worry about it. Well, now they're very much suggesting that it's going to stay up longer and higher than they originally expected. And they're particularly concerned if that is to be the case, it's going to start de-anchoring inflationary expectations, lead to higher wages, the usual kind of cycle, and as a result of which they're going to have to do something about it. It's not guaranteed because at the last meeting in September, the vote on interest rates was a unanimous 9-0 in favour of no change. And indeed, at least 2 MPC members within the last few days have come out and, well, effectively intimated they don't think the conditions are appropriate yet to come out and raise interest rates. But since the governor is really talking the hawkish line, it kind of looks as if we will see rates going up sooner rather than later, in which case, as I mentioned, that would put the UK ahead of most of the other big central banks. And it's certainly reflected in the pound at the moment, which has had a very good run against the likes of the euro, to a slightly lesser extent against what has been a strong dollar because of the tapering expectations there. And I guess it kind of leaves the pound looking a little bit vulnerable, because there are still risks on this, in addition to the fact that it's not guaranteed we're going to get 5 members of a nine-person MPC to actually vote in favour of higher interest rates before the end of the year. The economy at the end of the day is still slowing. Most of the indicators suggest that we've got relatively sluggish consumer demand at the moment. Retail sales have fallen in every month in the last 4 months. The labour market's doing okay, but there's still concerns that we could see some weakness there because of the furlough program, which has been supporting employment wages for such a long time now. That was terminated in September time. And the bank's been intimating for, some considerable while that it wanted to see the impact on the labour market of the withdrawal of fiscal support before doing anything with policy. So I can't help wondering myself if these financial markets haven't got a little bit ahead of themselves. And if we do see any tightening, it's going to be relatively mild. But it's certainly something to keep an eye on, because it does mean that the Bank of England's meeting, say in a couple of weeks' time, is going to be one of the more important we've seen coming out of the UK for some considerable while. I'll round off my bit quickly by just mentioning some of the politics, and since it's politics, I'll deliberately keep it short. But there is something of a verbal punch-up going on at the moment between the European Commission and the likes of Poland and Hungary over, effectively national law versus EU law. It's especially true of Poland at the moment, where there's a ding-dong battle going on with the EU Commission as to whether or not it should be the European Court of Justice, which ultimately determines Polish law, or whether it should be the Polish High Courts, which have their own national say. Now, it's got to the stage whereby there is increasing speculation that Poland could be the next country following the UK to leave the European Union. It should be said that neither the Polish government nor the EU wants to see Poles exit. But essentially, if this issue cannot be resolved, and it's fundamental to the working of the European Union, then it may be the case that Poland will have to leave in any case. It's not really something which is impacting the markets particularly currently, but this thing continues to rumble on, then it's something which could certainly start to undermine investor sentiment in the euro. Okay, then I think that's probably my little bit. So anyone on the team got anything else they'd like to say before we round this off?
No, I think that's good.
Deathly silence. That's what we like. It means we've done it all. Okay, then that is it then. I'm probably sure we've been talking for far too long already. So let's wrap it up there then. What can we say? Well, yes, varying degrees of slowing economic growth and rising inflation may be a central banker's worst nightmare. But for financial markets, the current and prospective dislocations in monetary policies should provide plenty of trading opportunities. So remember to keep up to date with all the latest news on central bank activity, as well as the key market moving data and events in Econoday's global economic calendar. On behalf of Terry, Brian, Max and myself, thanks as ever for listening. The podcast will be back again in a couple of weeks. We hope to see you then. Bye for now. Strategic investing and analysis are a lot easier when you can identify patterns and see how economic events and announcements correlate with specific market movements. The Econoday Investors Journal provides a convenient and easy way to follow important economic events every day, every month throughout the year. View the most important market-moving events for the upcoming year in a glance. The Econoday Investors Journal is your essential desktop resource for economic events and indicators, FOMC meetings and announcements, US banking holidays, equity settlement dates, and more. The Econoday Investors Journal is much more than a financial calendar. It's an indispensable tool to help you anticipate active days in the market. Learn the intricacies and interactions of the market, record daily market activity, and explore helpful insights from experienced market analysts. Take advantage of our informative resource centre, which includes a comprehensive glossary of need-to-know terms, clear, concise information on policy and historical trends, useful graphs, and a guide to the influencing factors and people to watch at the Federal Reserve. Order your 2022 Econoday Investors Journal now at shop.econoday.com.